It's a mantra you know, but it's a mantra that needs repeating in times like this. Stay invested and stick to your plan. This is the fastest 4 minutes in finance. Hello, I'm Scott Inman. Well, if you're a regular viewer or listener to this segment, you may grow weary sometimes of hearing us tell you to stay invested. But the message doesn't change just because the markets do. And the facts don't change either. This week, we take a look at a chart from Rowe Price showing us a tale of two investors. So let's set it up. Both investors began contributing $2,000 each quarter to their investment accounts in 1990. They both rode out the market roller coaster until March 30th, 2001. At that time, both investors had a portfolio value of $177,502. From that point on, investor A stayed in the stock market for the duration and continued to contribute. Investor B didn't. They decided they needed to avoid steep losses. So when the stock market dropped 10% or more in a quarter, they moved their account balance and contributions to cash. They waited out the volatility and moved back into stocks only after 4 consecutive quarters of positive returns. So how did they do? Well, the chart tracks performance from 2004 through 2024, moving through volatile times like the global financial crisis, the downgrading of U.S. debt, the COVID-19 pandemic, and the Ukraine conflict. At the end of that 20-year run, investor A had turned their $177,000 into over $2.3 million by staying invested. Investor B had a portfolio worth just about $368,000. Now, stock performance is represented here by the S&P 500 index, and no one can directly invest into that, so it's for illustrative purposes only, and past performance cannot guarantee future results. But looking backward, it's easy to recognize how investor B made mistakes, exiting the market after a downturn, locked in losses, and sitting on the sidelines caused them to miss the recovery. Now, I've had prospective clients come into our meeting room and feel pretty good about going to cash or stable value funds right before a big market correction. But in every case, the correction was months old, and the prospective client was still sitting on the sidelines. They had missed the recovery, and that recovery can happen quickly. According to Rowe Price, looking at market corrections over the past 20 years, defined as a drop of at least 10%, stocks usually bounce back and recover all of the lost ground on average after 3 to 6 months. For a bear market, defined as a drop of at least 20% off a high, the recovery did take longer, but for 2 of the 3, it took less than a year. Bottom line, there will always be market uncertainty. Now, currently, it's hyper-uncertainty, with constant fluctuation over trade policy, competing inflation and jobs data, and an investor desire for the Federal Reserve to cut interest rates. But you saw in those charts, we've faced much worse before. And history tells us that staying invested in the bad times will pay off in the long run.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.